The global economy is set for its weakest growth since the pandemic. Well, that warning came from the OECD. Its forecast showed that President Trump's trade war has hurt momentum in some major economies, including the US. It now expects the global economy to grow by 2.9% in 2025. In March, that prediction was 3.3%. Well, Toby Gibb is head of investment solutions at Artemis. Toby, how concerning is this prediction from the OECD?
I think it's concerning, but not totally unexpected. We did see, similar sort of projections from the IMF relatively recently. So, what the OECD is saying is that effectively the tariffs that President Trump is inflicting on the world economy are going to have an impact on global growth, as you say, sort of falling from above 3% to below 3%. And that's not unexpected. This will slow global trade. It's likely to put up prices in the US and slow consumption in the US, but also the tariffs are going to have an impact on not just consumer confidence, but also business confidence and their sort of willingness to invest. So I think a slowdown in global growth is not unexpected. What we need to do is really try to understand what the impact of that is on different companies, whether that's reflected in different companies' share prices, and really adjust and manage our portfolios accordingly.
Now, according to an exclusive Reuters report, the US is pushing for a final best offer on tariffs by Wednesday. Is this encouraging for investors in any way?
I mean, I think everything that we're seeing from the US is pretty concerning for markets. It's a lot of one day one thing is said, the next day that's reversed, and as we know, markets don't like uncertainty. They crave certainty, and they in this sort of environment, it's very difficult for investors to understand what next. It's very difficult for corporates to make decisions on investment. So all of this uncertainty is very, very difficult. So if we do see some more certainty as a result of Trump's latest statement, then that would be great. But I think that's unlikely, to be honest. I think we've got a long way to go with Europe. I think we've got a long way to go with China, as we've seen over the weekend with the escalation there. I think it's probably not going to be the end of this trade war and the rhetoric by any stretch.
Well, let's turn to Europe now. And Eurozone inflation slowed to 1.9% in May. A rate cut from the ECB later this week seems nailed on, doesn't it?
Yeah, I think it's pretty inevitable that we'll see a rate cut currently at 2.25%. The likelihood is, and what's widely priced into markets is that rates are cut to 2.0%. And I think the inflation print that came out today really makes that a pretty much a nailed on certainty, as you suggested. I think what's going to be probably more interesting following the meeting on Thursday is what comes out in terms of guidance, what comes out in terms of the minutes of the meeting, what the policymakers are thinking in terms of the impact of tariffs on growth for the Eurozone. So that's probably what people are going to be watching more closely than the headline rate cut itself, which, as you said, is pretty much a nailed-on certainty.
Well, Toby, let's turn to some corporate news now. We've seen in recent weeks a big rise in the European Aerospace and Defence Index, and today Rheinmetall has replaced Kering in the Stoxx 50. Is it too late for investors to start investing in stocks like Rheinmetall and other European defence stocks?
I think not. The Rheinmetall in particular has had a massive run. So it's tripled already this year. It's up, I think, 1,800% since the Russian invasion of Ukraine a few years ago. So huge move in the share price there. But that has been driven by massive increases in earnings, a huge increase in the order book, which now stands at around 60 billion euros, and expectations for material further revenue and earnings growth driven by what we're seeing, which is huge increases in defence budgets in Europe and elsewhere. So this move, so with Rheinmetall moving into the index, that creates marginal buyers for the shares. So it will become part of an index which is very widely used by passive investors, also an index which is very widely used as the basis for widely traded derivatives. So that's positive in terms of creating more marginal buyers. And I think also what we're continuing to see is investment funds that previously excluded weapons manufacturers from their funds are now starting to remove those exclusions, given the sort of the changing dynamics and sort of geopolitical situation. And again, that has the potential to create more marginal buyers for defence companies.
That was Toby Gibb from Artemis. And don't forget, you can watch more videos on Reuters.com.